Welcome back to another episode of the Winners Club podcast, where even when we don't win, we learn, and learning is the highest form of learning. Guys, my name is Brian Tran. I got my co-host there, PJ Padua.
What's up, guys? How you doing?
And we have an amazing guest. We have Amanda Hahn here, who's the founder and director of Keystone CPA, and they are tax strategists, CPAs. They're here to save you money, because what you don't realize, people, is that the IRS, the government, Uncle Sam is your silent partner. And if you don't take action, they will have their hands in your pocket. So that's why I'm very excited to have them on the show today, because let's face it, we are approaching the end of the year. As today of filming, we are 1 day or 2 days away from November, which means we only have 2 months to figure out how are we going to save some money, or what do we need to buy? What do I need to depreciate so I don't have this big fat bill to pay at the end of the year, right? So let's get right into it. PJ, I know
Thanks
you got
for
some
having
questions
me.
for her.
Yeah, of course. Amanda, well, we would just love, I know we got the intro going, but please, what's your elevator pitch for yourself? How would you go with that?
What I tell people is I'm a CPA by day and real estate investor by night. So, like many of you in our audience, I also am an investor too, myself. And one of my passions is in educating people on what you can do to save on taxes. I love that Brian mentioned the IRS is your silent partner. It's kind of the partner you never asked for, right? To be on your team, but there they are all the time. Tax planning is one of the only ways that we can really protect the money that we make from taxes. And yes, year end is sort of the absolute last point of the year when we can put some last minute moves in place, because where your numbers fall on December 31st determines how much or how little taxes you pay. So it's not next April, it's today that we're looking at how to save on taxes.
Awesome. I mean, making money is great, but I think I've heard Brian say this, keeping it is way more important, right? So guys, you're in for an amazing episode. I just want to ask, Amanda, why taxes? Where did that came from? Where did that start for you?
For me, gosh, I don't know. I think my mom was an accountant and one of my uncles was a CPA. And I come from a family of entrepreneurs. So my grandparents, when they were in Taiwan, they owned real estate, they ran businesses. And I always knew that accounting was the language of business, finance, accounting, tax in general. So kind of always just had an interest and passion in doing that.
That's kind of funny, because I love money, but that doesn't mean I like to deal with spreadsheets and all the math that you guys have to figure out. But that's kind of interesting. So
Yeah.
you said you're a real estate investor, but you also do tax planning, prepping, CPA stuff. What came first?
CPA for sure. I'm actually a third generation of real estate investor. So, like I said, my grandparents invested in real estate, my parents dabbled in it. And in fact, growing up, when we first immigrated to the US, we lived in the same condo community where my grandparents were the landlords. So they were super hands on, kind of do everything yourself, knock on the doors to collect rent. And I decided that's something I absolutely did not want to do. I wanted to be in corporate America, get a job, which is what I did. But when I started my career in public accounting, I went to one of the big fours and I happened to end up in the real estate group. So I ended up working with real estate investors and really seeing firsthand how very wealthy people who work with those very large firms are able to pay little to no taxes.
So you worked for the big four, and then at what point did you decide, hey, you know what? I'm not going to go work for big corporate America. I'm going to go work for myself, and I'm going to, create Keystone CPA.
I actually didn't decide that. Like I said, I was kind of like, I don't want to be a landlord growing up being, in the area where I did. But my husband was actually the one who read Robert Kiyosaki's book, Rich Dad, Poor Dad. And he just said, we should start investing in real estate. And I really thought he was crazy. It's sort of like we do taxes for rich people who own real estate. We don't own real estate. But he talked me into it. And when we started investing, most people, right, you just start small with single family homes. I started going to real estate events and meeting regular folks who were doing real estate investing. And that's when I think we realized that a lot of the strategies and the planning that we did in Big Four with very high net worth people were not available to everyday investors. Normal people don't think about taxes the same. We think of taxes as a bad thing, a punishment, whereas wealthy people think of it as a reward. How can I leverage it to help me build wealth? So that kind of started us on our passion project of, we can just start helping investors to do similar things, right? But we just have fewer zeros behind. But the strategies and the concepts are the same.
So share with me some of the strategies and concepts that you learned from the Big Four that maybe the audience can go back and talk to their CPAs about.
Well, I mean, I think, in general, right, one of the major differences with how the wealthy look at and use money is they use what we call the money loop. So money loop meaning, how do I make money in my business or in real estate where I don't have to pay 40, 50% of taxes on, right? Especially if you live in a high taxing state. And so you do so by creating appreciation. If we're talking real estate specifically, I buy property, I rehab it, I increase my equity by $200,000-$300,000. And instead of paying taxes on that, I refinance against it. So I've now created asset without paying taxes. And then I leverage it to access the money tax-free through a loan, and I reinvest it, which then gives me more write-offs. And that kind of completes the loop over and over and over again. So I think there's a lot of talks, especially in the media, about how tax code favors super wealthy people. But when you think about it, what I just described in the money loop is something that's used day after day by even the smallest of real estate investors.
Yeah. I think people always think that it's only for the rich, but I think it's just a lack of knowledge, lack of resources. But that's why, guys, if you're listening, we're going to bring it all to the table, and you can go back and you can apply it. And actually, you can probably hire Amanda to do it for you. Am I right? Are you taking new clients right now, Amanda?
Yeah, for sure. And one of the things that is really interesting what you just said, there's a famous quote in the tax world by a judge. His name is Justice Learned Hand. And he said, in America, there are two tax systems, one for the informed and one for the uninformed. Both are legal. And so I think it's really important, for the folks who are listening to us and watching us, is now you're spending time to become informed so that you can actually do something about the money you make rather than just to lose, a third or half of it to taxes.
There's something you said there. I think for the most people I talk to, and these are even people that make a lot of money and they're making seven figures, but believe it or not, to them, what makes a good CPA is just merely the fact that, oh my God, I didn't have to pay anything, which is true. But if you don't know, there's two ways to not pay taxes. Number one, you have major write-offs, which to me isn't really a good thing, because then, and correct me if I'm wrong, Amanda, but on a write-off, it basically shows that my company or myself, I made nothing. It's an expense, and so when it comes time to getting loans, I now don't have the income to verify, to justify that I can afford the loan. Now, there's another set, which is, I think what you're going to tell us about, is depreciation in real estate, right? Where lenders can actually add that depreciation back into your income because it's a paper loss. Is that correct?
Yeah, for sure. And, in working with real estate investors, one of our favorite words, of course, is leverage, right? So in addition to saving taxes, we're always looking at, well, how can I still be bankable as well? And that's what you're talking about, Brian, where I write off so much that I cannot borrow money anymore. And so depreciation, the whole concept of depreciation, which is our ability to take a paper loss for the purchase price of the building. And that's true regardless of whether the market's going up or down, right? And so being intentional about how you file your tax returns, working with a lender who is strategic and can explain the whole concept of a paper loss to the underwriter is huge, because that's where you see people who on a tax return show a big loss, but for loan purposes, they're not upside down, right?
Yeah.
Which is where you want to be, so you can actually get loans and scale the portfolio.
So, obviously Donald Trump's our president now, and I think his last election or this election, I don't remember the date, but they were like, you need to show us your tax returns. And he didn't want to show it because chances are, if you look at it, it's probably going to show that he didn't pay any taxes, right? And I think that that's because the uninformed part of America will probably look at that and be like, well, you didn't pay anything. Or, how come he's a billionaire and he doesn't pay any taxes? Would you say that it's because, but the informed will probably know that, hey, he owns a lot of real estate and he's depreciating things. Am I right? Or what do you think?
Yeah, for sure. I think they ultimately did release part of the tax return. And what's really interesting about that is we just joke, like in our CPA community, that his tax return actually showed a refund, which is, people might think getting a refund is great, but it's actually not great, right? If you get a big refund, that just means you made an interest-free loan to the IRS. I would rather keep my money and invest it, right, every month. But yeah, that's right. I mean, obviously no surprise for somebody like that a lot of business benefits from, deductions and using leverage to increase assets for your business, but also depreciation as part of business or real estate as well.
I didn't know that. He got a refund. So he does. So that means he does, guys. If you're listening, Donald Trump does pay taxes. He's paying his estimated taxes every quarter. I'm gonna be honest with you. I don't. I pay the penalty. And Amanda, I'm horrible, but I'm I love buying real estate. So throughout the years, for
Yeah.
as long as I can remember, I never pay the
Mhm.
estimate because I take that money. I use it to go flip properties. I use it to go buy properties. And then at the end of the year, I pay the penalties and the interest because at the end of the day, it's actually cheaper for me to pay the penalty than it is for me to go borrow
Mhm.
from the hard money lender at 9 and
Exactly.
10%.
Yeah, that's a strategy for a lot of our clients who flip, because you're right. What we're comparing with is what is the potential interest and penalties for not prepaying versus what is it costing me to get a hard money loan, right? And just the time value of money, the ROI of the fact that you have cash with you. But something you said that was really interesting earlier, you said a lot of high income earners think their CPA is doing a good job because they're getting a refund and they pay no taxes. Again, that's a very bad job, because ideally where we want to be is sort of a break even by the time you file your tax return. If you got a big refund, it means you did poor planning, poor cash
Mm.
management, right? You didn't know, and so you overpaid or over withheld on your paycheck.
Let's talk about that because up until recently, I didn't know the difference between a good CPA and a bad CPA. I really didn't. And it wasn't until I needed the planning, I needed somebody that can explain it to me in a way where it made sense so that I do what they tell me to do. But
Mhm.
up until then, my last CPA, they didn't really tell me crap. They were just like, give me your P&L, give me your, what is it, your last year's tax. Well, they have the last year's tax because they did it, but then they'll ask me for the bank statements, what's my ending balance for all the accounts. And they just started crunching numbers and said, this is what you owe, right?
Mhm.
But can you break that down? Like, what makes a good CPA and what makes a bad CPA so that the audience can go and find a good CPA?
Well, I mean, what you just described is the process of filing a tax return, right? And we all do that, right? We all have to file tax returns. Basically, I give them my numbers, they put it on the forms, and they tell me what the result is, right? Whether I overpaid or I'm getting a refund, which is very different than tax planning. So, tax planning is when you meet with your CPA during the year before you enter into big transactions. Hey, I have a flip, I'm going to sell it for $2 million profit. I want to meet with my CPA before I sell so I can look at what are my options around that. How should I time the sale of my flip? And or before you leave a job, before you get married, before you partner with someone, right? So those are all investment moves or just personal life moves. They present opportunities for you to do tax planning, even like, if you're getting married or having kids. Right now, if you're getting married, you got two combined incomes now. Is that good? Is that bad? When should we do it? The reason planning is so important is because if you think about it, the tax code is designed to incentivize us to do certain things. And
Yeah.
so before you do certain things, your CPA can tell you, hey, if you do it this way instead of that way, you're going to save on taxes. So how do you know if you're working with the right CPA? Is you ask yourself, what is my tax saving plan? Like, what is my personal plan? And if you can't verbalize it, then odds are you don't have a plan. And so you're not working with the right CPA. The right CPA is going to help you determine what that is.
Yeah.
And it's not a super scary thing where people like quiz you on math problems or anything. That's what people think when I say tax planning. It's like, it's going to be a quiz and I'm going to be judged. But it's really just a regular conversation. I'd be like, hey, so Brian and PJ, you guys are going to a deal together. I'm like, tell me what Brian's going to do. What's PJ going to do? What's our expected profit? And it's just those conversations where the strategies are developed.
So PJ is he's got really excited. I think he's gonna hire you after this because you said something that in his ears started to twitch a little bit, which is like, should you get married? Should you not? And so he's gonna ask you to have a conversation with him and his girlfriend, and he's gonna want you to convince her that it's better not to get married, right, PJ? I know where you're
I
going,
can't
PJ.
confirm on that. I don't really remember having that conversation. But since we're on the topic,
But PJ, you know why? Like, hey, I'm joking, but
yeah.
PJ, the reason why you don't want to always get married because the audience is probably gonna be like, wait, what the hell? Why? Is because sometimes you might make a lot of money, she might not. When she has kids, she can put those kids under her. She's a single mom, and now you get all the perks. Am I right?
Is that true? I don't know. I guess I do need to talk about this.
Yeah, for sure. And I think, also it's just different for person to person or couple to couple, right? The other could be true too, where like if you're somebody making high income, or let's say she's somebody in tech making high income and you're doing real estate full time, then great. We get married and you can use all the real estate benefits to offset her tech income. And again, tax planning is not something super scary or like an alien type stuff. It's just a conversation in the day to day of what you're trying to do and how do we make that as tax efficient as possible.
I love that. So you just mentioned like, high tech income earners.
Mm.
And we all know that like rental properties obviously bring some wealth appreciation, but for someone who's trying to buy a rental property with high income, how does it help them specifically with their taxes?
Well, I mean, we mentioned, in real estate, we have the benefit of depreciation, right, which is the paper loss we get to write off. After the passage of the One Big Beautiful Bill, the tax benefits for rental real estate depreciation basically more than doubled based on what it was. So prior to the bill being passed, we had 40% bonus depreciation. Now we're at 100% bonus. So put some numbers to it. If we had a client who previously was expecting $100,000 of depreciation, now they can expect over 200,000, right? Just based on the law change.
Wow.
Same property that I bought in March of this year. So similar, just, same property, but just a higher percentage of depreciation. If you're someone that's working in tech, and we'll assume they're working full time, in order to use rental benefits against W-2 income, assuming that's what we want to do, either you have to be a real estate professional or you have to marry a real estate professional. That's why we're saying PJ is going to get married if a girlfriend is working a high tech job.
Yeah.
The other way to do it is if you're single and you don't want to be married, or both married couples are high income earners and neither of them wants to do real estate full time, you can also invest in short term rentals. So we talk about the short term rental loophole. Why is it called a loophole? Because when you invest in short term rentals, you don't have to quit your job. You don't have to go into real estate full time. You can keep doing what you do, and real estate could be a side hustle. You could potentially use real estate benefits against W-2.
What are some other ways for people to become a real estate professional? What are the requirements?
So real estate professional really is just a designation for tax purposes. Okay, so it has nothing to do with your license or anything. The three rules are: one, you have to have at least 750 hours in real estate. So that could be a realtor, a landlord, construction, all that kind of stuff, flipping. The other rule you have to meet is you have to have more time in real estate than your job for that year. And that's the one that's the hardest for people to overcome. If you're working full-time in tech, 2,000 hours, you have to have more than that in real estate. And then the third one is you have to meet material participation, which is the day-to-day operations of your rental property. So once you meet all three of those, or if you marry somebody who meets all three of those, then your long-term rentals can offset all types of income, no, not just rental.
I don't want to throw anybody under the bus, but I was talking to a CPA before, and they were saying that I do not qualify as a real estate professional because well, a little bit of backstory about myself. I have 9 other companies. One of the company, and I guess half of them are real estate. The other half are not. And the other half, I make more money off of those than of the real estate. And she said, I can't be a real estate professional. But so I didn't understand, because I said, if you were to look at my calendar Monday through Friday, hell, Monday through Sunday, it's 90% real estate. I'm looking at properties, I'm running a brokerage. I even list a few properties, like a few a year. And I said, just because I make more money in something else, how does this disqualify me as a real estate professional? Am I wrong, or was the CPA right or wrong?
No, you're right. And it's a common misconception for CPAs to think that it's somehow involving the dollar amount of income.
Yeah.
But, I just mentioned what is a real estate professional. All three things that I mentioned, the three rules, are all about hours. How are you spending your time in real estate versus non-real estate? So what you described is not an uncommon profile. So a lot of our clients are very successful in real estate, right? Flipping, rentals, and then they start to branch off into other types of businesses as well, right? I mean, some are peripheral real estate, like management company, and then others are just doing maybe like social media type of work or coaching and things like that. And ultimately, regardless of how much income you're earning in each source, that part doesn't matter. What the IRS will look at is how many hours is Brian spending in real estate versus non-real estate businesses. And that's how you determine whether you're a real estate professional.
Yeah, see, guys, that's why the right CPA will save you money and the wrong one will misinform you, right? And I think really what it came down to was that they just didn't ask me, and they just try to tell me that, hey, I'm the
You're
CPA here.
not.
I'm the one. Like, I see your paperwork, and this doesn't make sense. And I'm like, okay, all right,
Yeah.
but
It's
I'm a fighter.
unfortunate because, yeah, I mean, it's really unfortunate because we have whenever we do planning with clients, the first thing we do is look at previous year's tax returns because it tells us a lot about what they own, what happened in the past. And I've talked to so many people who tell me, oh, my CPA is great. They specialize in real estate or they own real estate. They own apartment buildings. Later to find out when I see the taxes that they're not claiming real estate professional. And it's always really maddening for the client to find out because it's kind of like what you're saying, like, you know what I do. You know that most of what I do is real estate. Why didn't we claim it? And sometimes the answer is like, well, you didn't ask me to. So I didn't. Yeah.
Oh,
It's
yeah.
really crazy. But what I'll tell you is this. If somebody in the audience is like, hey, am I working with the right CPA? I don't know. I think I'm claiming real estate professional. I think I'm doing cost segregation. Instead of just assuming it, you can ask your CPA very specific questions like, how much did real estate professional save me last year by me claiming it? How much did it save me? How much did cost segregation on my new rental property save me in taxes last year? Right? So don't assume, ask them for a dollar amount because then you'll quickly know if they didn't do it. They're gonna be like, well, you didn't claim it. I
Yeah.
can't tell you how much you saved because you didn't do it. It's a good way to kind of find out, right? What's the dollar amount of my savings?
Yeah. Wow, that's actually really valuable, to be honest. Just ask the question you need answered, right? Since we're on this topic, I want to ask, what's the craziest legal tax deduction you've ever seen someone claim?
The craziest legal tax deduction. I mean, I don't know that any of them are crazy. I just think that it's the ones that people aren't aware that you can claim them, right? I think probably the most common one that's misused or misunderstood is the ability to shift income, whether it's to like your kids or maybe you have parents who are in lower income than you, where, if you can pay them to help out in your real estate business, you can take a tax deduction for it. And the benefit of that is, depending on what their income is, the money you pay them could potentially be tax-free, or it's maybe taxed at a lower rate than you. Because people always ask like, well, I give my parents money. How can I write it off? And the common CPA answer is no, you cannot write it off. You're just giving money to your parents because you're a good son or you're a good daughter. So the better question is, how can I take a tax deduction for the money I'm giving to my parents or the money I'm giving to my kids? And the answer to that is, well, can you shift income to them by having them help out in your business, right? If so, then it becomes a legitimate business deduction.
You hear
Wow.
that, PJ? You can start giving me your income.
Okay, I'll think about it. Yeah. All right. I don't know if I'm gonna have enough income now. I want to hear, like,
That's a
do you have
tax
any?
scam. Shift your income to me.
You heard it here first, guys. But I want to ask, what's the wildest client story? I mean, there has to be maybe, December comes around, and they're like, hey, like, we got to go to work because I didn't do anything. Or, do you have any stories that just remind you of like, man, that was a wild time?
I mean, I'm working on a pretty crazy one right now. We have a client who came into a windfall of about $10 million for the first time. I mean, our normal income year is less than 500,000. So they came
Wow.
into $10 million of income and has some real estate, but somewhat new to real estate. So we are doing a lot of different strategies, in terms of real estate, short-term rentals, charitable donation stuff, shifting income into a corporation, income shifting to the kids and everybody in the family.
Yeah.
So I think we're projecting probably bring down taxable income by about $8 million. So pretty crazy,
So he's only going
pretty
to pay
crazy things
taxes off of 2 million.
of
So
two.
maybe, and I'm guessing they're California, so they're going to owe 1 million only.
Well, California is a whole different beast. So a lot of the tax benefits that we get for federal does not apply to California. In case you didn't know that, for all of our California listeners. So California taxable income will still be somewhat high, but for federal purposes, yes. Our projection is going from 10 million down to about 2 million of taxable.
Assuming highest tax bracket, 33%. So of 2 million, so 600,000 there. Another 13% on 2 million, so another 200,000, so 800 something, 800,000 or
Yeah.
so.
I would look at it as, what were the taxes saved, right?
Oh yeah,
So
definitely.
you know
Because
what
if
I
you
mean?
didn't,
Like 37% of $8 million, basically,
yeah.
right? That's the
That's a lot
taxes
of money.
you were
Well,
otherwise
think
going to
about it, because
pay.
otherwise it would have been 50% of 10 million
Yeah. Yep.
if they didn't do it right.
Yep.
Wow, that's
Yeah.
amazing.
Yeah. I don't know. I don't want to claim the whole success story to myself, right? It's kind of a team of people. I'm on the real estate tax side. They have, like a charitable specialists who do it, but it's definitely possible. And so when you hear people, a lot of times CPA or people are told by their CPAs, like, there's nothing you can do to reduce your taxes. Again, ask, how can I, right? What are the things that I could potentially look into instead of just assuming I don't want to do any of those things? Like, I've always had people say, well, I paid so much in taxes, my CPA never told me about the short-term rental loophole. I would have loved to do it, right? And I think that's the downfall of most accountants are like, well, you didn't tell me you want to invest in short-term rentals, instead of saying, well, I could have told you that was an option. I didn't know if you liked it or not, right? But I'm going to give you that option. And that's really what planning is about, giving you the option to decide whether you want to do something.
Speaking about high net worth individuals, I've heard of something called a private family foundation. What is that?
So it's part of the charitable planning strategy, right? Family foundations, charitable trusts. So basically looking at, if I'm a high income earner and I have to pay a bunch of money to the government anyways, am I better off putting it into charities of my choice? And it's just, so charities could be, Red Cross or your church. It also could be a family foundation where you set up for charitable purposes, but you guys just have more direction or control over the use of that money and how that's done. And so when you look at a lot of, like politicians, right? Like President Trump and just a lot of people probably in DC will have these kinds of things that are set up, because for them it's tax savings. It's also looking at generational tax planning and wealth preservation, right? I think when we do tax planning, you're always looking at, how can I pay myself rather than the IRS? How can I pay towards my retirement account? How can I pay towards my kids? How can I pay towards their education or my family foundation or my charities or other people's charities rather than IRS?
Interesting. Okay, my mind is racing, but I don't want to
Or how
incriminate
can I
you.
pay towards like my real estate, right? How can I buy more real estate versus give it to the government and have zero return on investment?
I guess the charity can do anything. It can even be my charity, and my
Yeah,
charity
yeah,
just goes and does stuff in this city that benefits me,
yeah.
right?
The family foundation is, yes. So part of that is you have more control than if you were to donate to your church, right? As an example. Now, in all charitable planning, there is always actual charitable component. So it's not like I'm going to call it a charity, but it's actually just going to go to my kids and video games. And, I'm going to go to Bora Bora for personal pleasure. But yeah, if you structure it correctly, the goal of it is so that you can maximize your charitable intent rather than to give all that money to the IRS.
Understood. Got it.
Okay. Amanda, I want to ask, legally, how can we write off a Lamborghini or a Rolls Royce or any of that? Does that stuff work when it comes, per se, for saying it helps your marketing? How can one do that? Is that even possible?
I think people use marketing as a common methodology into saying, like, I'm going to write it off because it's marketing. For car deductions, regardless of what kind of car it is, I think the most tried and true way to write it off is to use it for your business. So for real estate investors, whether you're flipping, rental, brokerage, all that, car expenses is pretty common. I think it's more difficult for someone who is like, we have clients who are social media influencers. All they do is sell stuff on Amazon. That's a little bit more difficult to say I'm using my car for business. But for real estate investors, we typically don't need to make the argument of marketing because you're already driving the car anyway, right, for business purposes. Now, the key though is, how much can I write off from my car? And that comes down to business use percentage. So if I have a car, I'm only driving it 10% for business, but 90% is just like for my weekend fun, then you can still take a write off, but it's very small. It's like 10% of whatever the total is. But if you have the car that's used primarily for your real estate, now your deduction is going to be much higher, right? So a car that's 100% business use, you get a much larger actual benefit than if you have one that's used 10% for business, as an example.
PJ, that's why I have an Escalade and I have a G63.
For sure.
Yeah.
Yeah, that's the thing too. And we recommend for people too, if you have two cars, right, much easier to substantiate, this car I'm using for personal stuff, going to the grocery store. The other car is used when I'm using for business, taking investors around and, taking customers around, right, taking my clients and stuff.
And I have proof, PJ. Like, there's so many videos of me driving all the realtors and driving all our project managers.
For sure.
I just pack them in the car and we go to all the job sites. And I'm like, "Hey, do this, do this, do this." And I have videos of me putting stuff in the trunk, bringing it to the job sites.
Necessary.
Very. All
Yeah.
right.
It's interesting. I don't know if you guys saw the IRS came out, I think it was earlier this year or end of last year, about how they are using social media in audits.
Hmm.
So they're looking at people's social media, right, to see
Mhm.
like, what are you doing? Are you doing what you say you're doing? And
Hmm.
what's really interesting about that, I think a lot of CPAs are using that as like, oh my gosh, now they're watching all of our moves. But I think you can also flip the script on that and say, well,
Yeah.
now that they're looking at social media, let me use that to document what I'm doing, like what Brian just said, right? I'm
Yeah.
using that to document all the business things I'm doing. I'm using it to document my real estate professional hours of me driving around doing all of these things.
Yeah. It's like a real KPI now, like
Yeah.
all over the social media.
Like go watch my stories, guys. What are some hidden tax deductions business owners miss every year?
Gosh, I don't know that they're hidden. I think it's just most people don't have clarity on what they can write off.
Mm.
And people, I don't know why, but a lot of people think or are told that they can only write something off if they have an entity around it, So especially this time of the year, a lot of attorneys giving out bad information saying like, you need to form an LLC, otherwise you can't write off all this money you spent on your real estate this year. And that's just not true at all. IRS does not care if you have an LLC or a corporation. What they care about is whether that expense is associated or, ordinary necessary for your real estate business. Right? So if you're like brand new to real estate, even if you bought a rental in your personal name, but you had a lot of education, travel expenses, you can still write them off regardless of whether you have an entity or not. But I think just getting clarity around what is tax deductible is something that is often overlooked. We all write off mortgage, interest, property taxes, but what I see time and time again missed on tax return are these overhead expenses: car, home office, travel, membership, subscriptions, all that kind of stuff. I don't know why that is. People miss it. I think it's just not having clarity or thinking they need an entity.
PJ had a good question. PJ wanted to know, when is it like PJ sole proprietor,
Yeah.
LLC, S corp, C corp? What do people? I guess what
What's
should
best?
they open? Yeah.
Yeah. Like what's a new business owner? What should they do? And then when should they know to
Mhm.
switch is the initial question.
Yeah. Well, I mean, we'll start with real estate, right? Because in real estate, we make income in different forms. So if we're talking rental real estate, typically we look at an LLC, right? LLC partnership. And the reason for that is because it's super flexible. You can move property in and out of an LLC without having to deal with income tax issues or capital gains issues. So we generally don't want to hold rental real estate in any kind of corporation. Okay. Now, if we're talking about an active business, so in real estate, that would be realtor, flipping, property management, or if we're talking about, a CPA, an attorney, a doctor, right? That kind of active income, generally we recommend S corporation. So it could be an LLC you start out with. So if you're like brand new to business, you could start as an LLC, and the LLC can later choose how it wants to file taxes. So it could choose to be taxed as a partnership, or it could choose to be part of your personal return, or it could choose to be a corporation as well. And the reason we like that for new businesses is a lot of new business owners can relate to this, right? In our first year of business, or even maybe the second year, we have high hopes and projections of how we're going to make so much money, but maybe we don't make that much by the end of the year, right? And so if I have an LLC and I can choose how to file taxes later on, it gives me the ability to do a look back and say, I thought I was going to make 10,000, but I made 100,000. Now I'm going to tell the IRS my LLC is actually going to pay taxes as a corporation, and I'm going to save taxes on, as a corporation. Or it's like, well, my company made money, but I also bought a new car before the end of the year. So for tax purposes, is no profit. Then I can just tell the IRS, well, I'm just going to put it on my personal return. I don't want to pay a CPA to file a corporate return because there's no profit to pay the additional taxes on, right? So it gives you the most flexibility for new business owners.
And then what about like self-employed? Do you just not recommend that at all for any new business owner or?
I mean, it just depends. That the strategy for everyone will be different. If you don't have any other income, you're just self-employed. When I typically recommend this LLC strategy, where we can decide if you're going to be a corporation later. Now, if you're someone who has other income, so let's say you have high income from your job, and then you're starting a sole proprietor on the side. That's where we might say, okay, maybe it's okay just doing your personal name for now if you think the profit won't be too much. And the reason for that is because you probably already paid the highest payroll taxes through your job. So in the sole proprietor, we're not going to have too much to worry about. But if you don't have another job and all you have is sole proprietor income, then not only do you pay federal and state income taxes, you pay an additional 15% self-employment tax on top of that. And that's why we want like an LLC/corporation to protect you from that additional 15% layer. Yeah. I mean, if you put some numbers to it, like if you, let's say you're a new business owner or, third year, right? You make $100,000 from your business. If you operate it as a sole proprietorship, you're going to pay the maximum self-employment tax. So it could be like $15,000, right? On top of federal and state income tax. But if you ran that same scenario through an LLC where you tax it as an S corporation, then you might save $7,000 or $8,000 per year just on reducing that self-employment tax. So that's why there's a difference in like how much money we're talking about too.
So what would you say the revenue threshold would be for somebody to go from sole proprietor, or let's call it an LLC, to an S corp? Is it 50,000, 60,000 in income?
So it also differs depending on what state they're in. So California, every entity you form, there's at least $800 to the state, whereas other states don't have that. So yes, for California, our threshold is about 40,000 net profit after expenses, after your car write-offs, home office. After all that, 40,000 is roughly when we start looking at it. And the reason is because we have to factor in, we calculate the savings, but compare that against what is the cost to form the entity, the cost to pay the state of California, and the cost you have to pay a CPA to file an actual tax return, right?
So if you net more than 40,000, you should be an S corp.
You should at least start looking at it. You should have your CPA calculate the cost benefit. And that's kind of going back to why I said, the LLC/S corp is oftentimes the best structure, because you just don't know. I think it's 40,000, but maybe it's not. Even if you're sitting on 40,000 profit today, let's say it was PJ's made 40,000 this year, right, after expenses, but maybe next month he's going to go out and buy a new car, in which case we'll be at zero profit. So I would have prematurely filed taxes as an S corp, or did it too late. And the LLC is the best because it gives you the flexibility after the fact to say, actually, I do want to pay tax last year as a corp, so I'm going to go ahead and do that now.
Wow.
You get it, PJ?
Yeah, I'm getting it.
I always have to ask PJ because
so much value
this
today.
makes sense to me, and so the viewers, I got to make sure that we explained it simple enough, because it took time for me to understand this stuff too. But are we explaining it simple enough for everybody to understand?
I think so.
Yeah.
I definitely am feeling it and hearing it. It's something that just sparks the interest that I'm like, okay, I'm getting this, but I could definitely learn more. So I think we're doing a good job to all the listeners who have problems with taxes, or not even problems, but want to plan successfully.
Yeah.
But yeah, I have a really. Oh, go ahead, Brian.
So if you're an S corp, and in order for me to save on that 15%, do I actually have to establish payroll, and that payroll has to pay me a salary every single month, and it could be $2,000 a month or something like that? Because I don't want people to just think that they can just open an S corp and then be like, oh, okay, I save 15%.
Yeah, exactly. Yes, one of the requirements from the IRS is if you have an S corporation and you work in the business, right, then you have to pay yourself a reasonable salary. And we always want to look at what is the lowest reasonable salary, because salary I still have to pay payroll taxes on. And so if I made $200,000 in my business, I'm going to pay myself $50,000 of salary, right? Assuming for discussion purposes that's reasonable. Then the remainder of $150,000 that I didn't take out as salary, I can still take the money out. I take it out as dividends or distributions. And the benefit is I didn't pay that 15% self-employment or payroll tax on that $150,000. Right? That's my savings associated. So oftentimes, the more profit you have in your business, the higher the tax savings by becoming an S corporation.
Okay, I like that. If I want to have a question, if you have an S corp and you don't pay anyone out, that's definitely not something you should do, right? And you just
Wait, so you mean you have an S corp but you don't pay yourself? You don't take any money out?
Yeah, well, let me give a little bit more context. Oh, let's say you're self-employed, right? And that's kind of how you ran your business for a year, and then you decided to open an S corp at the beginning of the new year. And you plan to employ yourself or employ somebody to allocate the money, but you didn't do that, and you kind of just operated as self-employed the same time. What would you do at that moment? Do you just not report any profit off the S corp, or is there something you could do?
Yeah, well, it depends. So if you open the S corp, and if during the year you earned money in the S corp, right, then I would still report the income as an S corp. I would put myself on payroll before the end of the year so I can use that strategy legitimately. If on the other hand you're saying I have an S corp here, I didn't use it at all. I operated everything in my personal name. Then yes, in that scenario, your S corp was a shell. It didn't do anything. You still report everything personally, right? So it's really, for tax purposes, it's not just about creating the plan and having the entity. It's actually utilizing it correctly. And I see this a lot, especially, even for like people who own rentals. It's like, oh, I formed all these entities, but my properties are still my personal name. So I'm afraid of due on sale clause. I don't want to move it. And so then you just have a shell company that's getting you no asset protection, right? So you always want to make sure they match up, at least before the end of the year if possible.
And then if you didn't document any, or like you didn't pay anybody out from the beginning of year all the way to the maybe like the 11th month, can you still do something with that S corp to show that you paid someone out, or it has to be like every month has to be recorded?
Nope, you can. For new businesses, a lot of times what we do is just do a bonus at the end of the year. So like if my S corp made $100,000, I never did payroll. I just hearing about it now for the first time. You can just pay yourself a bonus, and that way, again, by the end of the year, you have a legitimate S corp, had the income, you took payroll, and then everything will be good going forward.
Okay, wow, that's really helpful, actually. Yeah, I have a friend that's like they're in the same situation, and I think this actually would really help them. So, guys, listen up. This is some real good advice. This is real value.
So
real
I have
And by
value.
friend, do we just mean you?
Nah, this is not my friend. That's not me.
We'll always
Not
get
me.
this on my podcast. Like, I have a question for my friend.
People don't listen to me. They don't listen to me. I'll tell you that, Amanda. They don't listen to me. I don't know why. Maybe because I just don't wear a suit anymore, and I just mess around too much. They don't listen to any of my advice. But I have a question, because now with the rise of AI, right? ChatGPT and the whole nine is getting so good. There's really no reason not to understand tax. And so again, might be my wrongdoing, and I'm not doing it because I don't like numbers. But let's say I go to TurboTax and using ChatGPT and listening to this podcast, I input everything myself. Is that good or bad?
It's funny. Somebody just asked me the same question earlier today. So we use AI pretty consistently in our firm, in CPA firm. And what we do is we actually subscribe to a couple of AI software that is specific to CPA. So it's not ChatGPT. It's like built for tax research and planning and all that stuff. And what we found is that a good percentage of the results it gives us is actually incorrect. However, we still continue to use it because it does help us speed up the rate at which we can find the actual correct answer. So for somebody who's not a CPA using ChatGPT, the thing I would caution is it's okay for you to use it, but always verify. Don't just rely on that as tax law. Verify with your CPA. Make sure it's accurate. Make sure it actually applies to you. Because for ChatGPT, a big percentage of what we find is actually just incorrect, and it will actually hallucinate. So we've done a couple of research where, it'll give us references to court cases that sound very real. It's like a Brian Tran versus US tax court and all the numbers behind it. And later to find out that's not an actual court case at all. And so when you ask chat, like, where can I find this court case? I'll say, oh, that's not the right one. Let me give you another court case. And that's also an incorrect or made up court case. So I think just more trust but verify, utilize it, but always confirm that it's first accurate. And more importantly, it applies to you, because that's what ChatGPT doesn't really know, whether that applies to your situation or not.
Yeah. My next question is, how like the tax code, like this, for example, the big beautiful bill, when you read it, I feel like maybe it's my natural instinct is to try to like argue my arguments that my interpretation is this, right? Like, is that kind of accurate, or am I just, that's my own personal thing and I'm like not doing it right? Because like, for example, if you read the First Amendment, the Second Amendment, the Third Amendment, like it's written, but I can argue it one way or another. Like is being like, are these tax laws, are they more black and white, or is it there's some gray in there too?
For sure. And a joke that we talk about too is like, if you ask the same question to 3 different CPAs, you get 4 different answers. Because sometimes, the same person might even interpret it differently depending on what the facts are that they're trying to look at. So, a lot of the tax rules, or in practice, a lot of what we do is rely on court cases to see, right? Because the law is just the law itself. And then the court cases give you guidance on, hey, this person did this is kind of what happened, this is what they decided on. And so, yeah, just like legal case law, there's a lot of that is open to interpretation. And at the end of the day, it comes down to what is going to be your ability to argue your case, right? And so kind of like when I talk to clients about attorneys, they'll say, well, I don't know who to hire. They tell me very different things. And I said, well, I don't really care who tells you what. I only care about what your attorney tells you. So I only care about what your CPA tells you. Why? Because they're the ones that will represent you if you're audited, right? You don't care what Amanda says. If Amanda's not going to represent you, you care about your CPA because that's who's going to be with the IRS not with you, against the IRS, if that were to come into question.
So for those listening, you should hire a CPA that's going to fight for you. I love it. Okay, my next question. This is another one. So in an audit, like I think I've been audited once, but we won. But I didn't do anything. The CPA just took care of it. Like, do you actually go into a room with the IRS auditor and go like, here's the stuff, or is it just kind of like an email and like, hey, this is what happened. Look, here's the proof that he was innocent, and then they go, okay, check, no problem. Like
it could be either. Yeah,
really?
IRS could be either. What they call field audits are where it's in person. They'll come to your office, they'll go to the CPA office, look at the paperwork and things like that. Or it could be like a remote audit where it's correspondence via written stuff, maybe some Zoom calls. So it kind of depends on the auditor, and also depends on your CPA too. One of the things we always like to do is kind of gauge the comfort level and like what the auditor wants to do. We work with clients nationwide. So sometimes if we have a client who's audited and they're in Florida and I'm in California, it's impractical for the client to pay me to be in Florida, right? And so IRS is usually pretty good about that. They're pretty reasonable. Like, okay, well, then let's make it a correspondence or Zoom because I don't want you to fly out to Florida, right? So they're usually pretty good about that. And I think just for anyone who's really fearful of audits, I think CPAs tend to over exaggerate what happens in an audit. A lot of CPAs talk about audits all the time. In reality, at least when we've dealt with audits in our firm, and our firm is heavy real estate. So, a lot of cost seg, a lot of real estate professional stuff. What we found is that auditors are, for the most part, pretty nice. They're just regular people doing their job. And if you can provide what they need in a very clean, organized fashion, right? AKA A+ student, that goes a really long way. If you try to make their lives difficult, if you're trying to just be a jerk and give them messy stuff, then they see you as like a C or D student, and they're probably going to pick harder at for them, they feel like there's more that they can do to audit you, right? So just be prepared.
Right when you said that, I just kind of, if you ever watch those old movies with the accounting firms, like you go in and it's like an old guy and it's like books and stuff everywhere. The office has like paper everywhere. I'm assuming those are the D's and the F students, right? And the guy goes, oh, let me look at your paperwork. And then they go over there and they grab something and then they're going through a whole bunch of paper. That's an F student CPA, right?
Yeah. Well, for us, when we do audits, it's like, if it's electronic, everything's color coded, reference for them. So it's easy for them to click and get to where they need to go. If it's, in person, we have these crazy binders that are like labeled and extra labels so they can be like, look right here and look right here. Because again, at the end of the day,
pretty much
just
if you go to if you go to PJ's desk right now, it's like, he would be an F student. It'd be like crap everywhere.
First of all, my desk is really clean, okay? Just to clear that up to anybody.
That's actually kind of cool because I always thought like, oh my God, like it's audit day. And then Amanda's going to go in there, put her gloves on, drink her Monster, and then like go fight these IRS auditors, right? But it's not. But it's actually, it's true that you brought it up. Like it is better to be nice than to try to flex your muscle and try to be tough. Because, you're going up against the IRS. Better to be nice.
Yeah.
That's
with everything.
Yeah, exactly,
that's everything
right?
in life. With your contractors, with your realtor, with your CPA, like be nice, right? You hire them to work for you. If you're mean, they're less incentivized to do it.
Yeah. I want to ask a question. What are some of your favorite tax hacks for digital entrepreneurs or creators or e-commerce, like kind of in that type of digital space?
Gosh, I love working with people in the digital space, and we have clients who are, like YouTubers, social media influencers in general, because a lot the business model for a lot of that type of revenue does not require a huge staff of employees. A lot of the support team is like 99 contractors. And so from that perspective, it's a lot flexible when we do tax planning. You don't have to worry about employee benefits. In other words, you get a lot of benefit to yourself as the sole owner employee. So if we're talking about 401ks, health insurance, medical reimbursement plans, all that kind of stuff is much easier applied when we're talking about someone who's digital, social media, that kind of income compared to like a physician running a medical practice, right? Those people, there's like a lot of staff that they have. And so when we do planning, we have to think about what do I have to fund for all the staff for benefits and retirement and all that kind of stuff. So I would say like fringe benefits, retirement stuff, those are all really good for digital content creators. And then just naturally the ability to write off more than most people, right? Again, for a physician, there's less, it's a harder argument to make in terms of writing off a lot of different things versus for content creators, it's more of a direct link. We have clients who sell stuff on Amazon, so they write off all the stuff that they buy for the house because everything that you use is something they're actually selling. And I can't do that as a CPA, unfortunately, unless I start selling like computers and I don't know, calculators and such.
Yeah.
So now you have me curious because, correct me if I'm wrong, I have friends that are in the entertainment space, and so they write off their watches, they write off their jewelry because it's in the videos, it's in these promotion that they shoot. Is that right? They can't.
It depends. Yeah. So it kind of depends, right? It really depends on the level of involvement and the item that we're talking about. So there's not like a one size fits all where you can never do it. And I don't want to say, hey, just because you have YouTube, you can write off everything you buy because it's in the video, right? So a lot of times the IRS will look at is it ordinary and necessary for that business or for that recording or whatever it happens to be. I would think that, if you're talking about somebody who is, has a big amount of income or following from being a celebrity or on TV or whatnot, it's a much higher ability to associate that kind of expense versus like, I don't know, me, right? Some followers, but does I really have to be wearing a Rolex for them to, see my YouTube video about short-term rentals? So that's a harder stretch to me. Not to say it's impossible, right?
Yeah.
It's just you have to work harder to try to make that connection. At the end of the day, what you're looking at is if you're ever audited and you're sitting across a table from an auditor, right? What's the likelihood that I can convince them this was ordinary and necessary for whichever business line I'm using it for?
You're right. So I got to become a rapper if I want to start writing off my. I got to become a big rapper in the hip hop space. If I want the chains and the gold watches, because that's kind of my. At that point, it would be my image, right? And I would need it. I need it, right?
I mean, is that is that something on the checklist though to be a rapper?
Yeah.
I don't know. Shoot, it's my friend. He writes off everything, and I guess. But now listening to you saying that, it's like a substantial amount of his income is from doing what he does,
Rapping.
Entertainment, and that's his image, that's his look, and that's his so I guess he can argue it. I guess I can.
For sure. And I think that's the thing, right? Is like people, and especially on social media too, maybe if your friend is big and he's talking about how he can do these things and he legitimately could do it, right? Based on his facts. But then the problem is then someone like me, I'm just like a regular person. I hear it, I'm like, oh, great. Now I'm going to do that too. And that's why I say tax planning is not a one size fits all. How you apply a strategy is very different, even between, PJ and Brian, even though you're the same business partners or whatever it is, it still applies a little bit differently because you have, different income, different girlfriends or wife or whatever, right?
Yeah.
Gotcha. I want to ask, so like, let's use like Mr. Beast as an example, right? If you make a YouTube video and you're going to, fly to Texas and then you're going to fly all your friends out and then you're going to go to a rodeo and you're going to review the rodeo and something crazy is going to happen. Can you write off pretty much everything that happened in the YouTube video and all the expenses if that's initially your business model, right?
Well, I think Mr. Beast is pretty famous for saying how he actually has no money, right? All of the money he makes, he spends it on all of the production and all of that stuff. So yeah, I mean, I think that's probably not a stretch for him. And it's so funny because I love watching his stuff, especially when he shares about finances and things like that. But yeah, I think the difference is, we like to say you're not traveling with friends, you're traveling with like coworkers or colleagues or investors, right? That's the difference, is because if it's a coworker or a colleague or an investor, then there's a business purpose to it. if I'm just traveling with my friends, then yeah, maybe someone like Mr. Beast could get away with it because that's a persona of, what he's doing. But for most people, what we want to try to tie into is, you're doing these things because there's a business relationship between you and those people. And also it's
Right.
just fun to, to co-invest and do business with your friends too. Right? The
Yeah.
people
You
that
know
you
what? Just
already
for the record,
know, like,
guys,
and
for all the
trust.
IRS, for the record, for all the IRS listeners out there who's looking at me, PJ is not my friend, okay? Ray is not my friend. Brandon, he's my nephew, but he's not my friend, all right? We are business associates. And so when we're going on these trips, like, it is a write-off because, I don't want to be with them. I have to because we're coworkers. And back to the show.
Yeah, for sure, for
PJ,
sure.
you're not my friend, PJ. You're only
I
there
know.
eating at Carbone and eating at all the steakhouses because we're talking business.
I know. I'm just filming all the time there. You know what I mean? That's
No,
just like all we do, you know?
That's right. So, Amanda, I want to be respectful of your time. So, my final question for you really would be, is that what's the biggest tax secret of the wealthy that anyone can use?
The biggest tax secret, I don't know, I don't want to say it's a secret. It's kind of like the money loop we talked about at the very beginning of the show, is understanding that we want to start shifting the framework of earn money, pay taxes, spend, and invest what's left over to flip it upside down, right? How do I make money invested first, get the write-off, get the savings, and with the money I saved from taxes, then reinvest? Again, I don't know that that's a secret, but I feel like that's something that all of us can do. It's just reordering or reprioritizing the order of how money goes in and out and doing it in a way that allows you to keep more of your money and utilizing it in the way that allows you to build wealth rather than just, spending it.
Love it. I think it's really is a secret because I think a lot of people, I didn't grow up hearing that and understanding it. I'm not going to lie to you. I only grew up understanding write-offs. That's the truth. And it was only because I started dabbling I got into real estate and then I had to learn and thank God for YouTube and people like you and all these other people who are on there sharing the information, right? And so it may not be a secret to you, Amanda, but it is definitely a secret. And I think it's just thank you for taking the time, sharing with your audience, and now jumping on our podcast and being able to share with our audience so that they can just learn this loop that you're talking about so that they can save money, save more in taxes, take that, invest it, not spend it on a Lambo, PJ, okay? Invest it and then arbitrage the money and then keep it going.
Then Lambo.
Yeah, and then Lambo, and maybe a
Or a
Ferrari,
jet.
and a Jesus,
Jet.
I want to write off a jet. Watch all these rich guys write off jets. We're gonna write off a jet, right, Amanda?
Yeah. You could start with like a membership to the jet, right? And then write off the jet.
And then the rap career begins.
What you don't know about
You gotta
PJ,
have the
he's
rapper
messy.
persona.
He is so messy, Amanda. Like this guy, when he eats, he makes a mess. And so if it was somebody else's jet, we'd be so screwed. It has to be our jet, Amanda, how can people connect with you? How can they find you? How can they work with you? There you go.
Yeah, my company is called Keystone CPA. And so you can go to keystonecpa.com. We have a lot of great free resources there. If you're looking for daily tax tips or just money tips in general, best place to find me is probably Instagram as Amanda Han CPA. And yeah, if you're looking for more in-depth content, I'm also on YouTube as well, same content. And if you're looking for a new CPA, I think company website is probably the best place to find me. We have a team who can talk to you about what your needs are and see if we can be of help.
Love it. Guys, we'll put all her information down below, but if you're driving and I don't want you guys crashing and looking at the phone. So Amanda Han, that's AMA. Damn it. I'm dyslexic. I'm sorry, guys. I tried. Amanda Han, guys. And with that being said, we will see you guys on the next episode. Peace.
Peace. See you later, guys. Thank you.